Thanks so much for being here, especially those of you who woke up extra early to join us today. We're thrilled to have you. We're going to let everyone file in and get started in just a moment. I'm Kate Westfall with Global Ag Investing, and this is part of our GAI webinar series that we've started since coronavirus has kept us all working from home. It's a good way to connect and stay informed and make sure that we're all sharing ideas and learning a little bit more about each other during this time. Today, we're super excited to have with us two of my oldest friends and people who've been with Global Ag Investing from almost the very start. We've got Bradley Wheaton, who's managing partner at Gunn Agri Partners, and Ben Craw, who's managing director with Oxley Capital Partners. You'll learn a little bit more about both of them as we go through the presentation. But what we're here to talk about today is really Australian agriculture as a whole, and where it's going in terms of value, and how each of you might be able to get involved in this awesome opportunity. So with that, I'm going to hand it over to Ben, and we'll kick off with an introduction of him and Oxley Capital Partners. Ben, take it away.
Excellent. Thanks, Kate. And thank you everyone for your time this morning here in Australia, of course, and good afternoon for those stateside. So my name's Ben Craw. I'm the Managing Director of Oxley Capital Partners. So myself and Bradley Wheaton will take you through our topic today. So just a quick introduction around the presentation today. You may have seen in the invite in terms of the topic we're going to explore is Australia's ambition to have an agricultural industry of 100 billion by 2030. So this is a vision that's been focused on with the Australian federal government and industry bodies being the National Farmers Federation to lay this goal and this vision. So currently agriculture in Australia is a $60 billion industry. So we require around about 40% farm gate growth in output over the coming decade. So it's an ambitious target. It'll require around about 3 times the growth rate of the previous decade. And reports suggest we will need around about $250 billion of capital between 2020 and 2030 to meet this goal. So to achieve the ambition, both domestic and foreign capital will need to play a greater role in the sector. So to maintain that sector's growth trajectory will not be without its risks, as our capital and trade partners remain in a state of flux with COVID-19 pandemic. And we're also experiencing tighter domestic credit conditions locally with increased regulatory capital constraints. So do you want to just add a point to that, Brad, before we outline the structure of the presentation and introduce ourselves?
Yeah, but Brad Wheaton from Gunn Agri Partners. Some interesting content to go through today. I think one of the really interesting overlays is the long-term strategic objectives for Australian agriculture have been set out by industry and by government for quite a while now, and this target of 250 billion has been set, but the realities of actually achieving that and the role for domestic institutional capital and foreign capital are really more pronounced today than they ever have been. So hopefully really interesting to the group that we've had join us today, and thanks for joining us.
All right, thanks, Brad. So just a quick bit of structure on today's presentation. So what we'll start with is around the capital requirements for the industry, considering both domestic and offshore sources. We'll look at some of the current market activity and tangible opportunities, and then consider some of the emerging investment themes in the local market, just with a super quick sort of deep dive in permanent plantings. And then that'll give us enough time to cap off with a Q&A session. So as we progress, please submit your questions through to Kate. So who's Oxley Capital Partners? We're an Australian independent corporate advisory and investment firm. We work with family-owned and corporate food and agribusinesses across the supply chain. We help our clients with gaining access to alternate forms of debt and equity capital, and that's primarily to support growth or transformation. So we liken that to joining the dots between those businesses that are looking for alternate forms of capital, more broadly with a global investor network. And our connectivity in the local market enables us to originate deal flow that's relevant to both domestic and offshore investors. So let's jump into our first slide. So as we can see on this slide, it outlays the middle bar there, the dark blue one. It depicts from the modelling that 250 billion is required to be invested in Australian agriculture over the next decade to achieve the vision of a $100 billion industry. As I outlined, it's an ambitious figure. It'll require an industry growth rate of around 4.5%, which is almost triple that of the prior decade of 1.7%. So a key growth enabler in that achieving the ambition will be capital. 2019 saw Australian agriculture produce around about $60 billion in goods. We've had some recent seasonal volatility. The market stepped back, but now we're up to about $62 billion in farm gate output. So we've kind of gone 2 steps forward, 1 step back with some seasonal volatility. And with that, the current forecasting suggests that we're on target to reach around about 85 billion by 2030. So we've got a gap of around about $15 billion to achieve that vision. So this slide here really highlights the sources and uses of capital required to meet the $100 billion vision. And as I outlined, it's a $250 billion worth of capital that's required to support production growth. So when we look at the chart, the first bar depicts capital required to support productivity. The second bar is really around supporting farm turnover and replacing depreciating assets. So broken down annually, capital required to support farm turnover alone is around about $9 billion. So when we look at the sources of capital, debt and internal equity, so retained earnings, profits, are forecast to fill around about half of the $250 billion capital required. So that leaves us a capital gap of approximately 125 billion over the coming decade. So if you annualise that, it's around about 12.5 billion that needs to come from off-farm sources to meet the $100 billion vision. So Brad, did you want to just jump in there with some commentary?
Yeah, thanks, Ben. So interesting, on Monday, there was a report released by Australia's Productivity Commission that looks at foreign investment across all the different industries, and they look at the foreign investment going into agriculture. So really the most recent data set as of this week, which is helpful today. And I think the key message from that, and the key message that you'll see here in this presentation, is that there is a lot of focus in the media and from policymakers on the quantum of foreign direct investment into agriculture and the source of that foreign direct investment. But the reality is really quite different. So the message, always believe the hype. And what was reported on Monday is that there was, in the year to financial year 1918, that there was $7.9 billion foreign capital going into the industry. So it's less than 5% of all FDI. And so in that capital stack that Ben's just set out, you know, that's less than 3% of that capital requirement. So there's a huge potential contribution that can still be made by foreign capital. And one of the things that we will look at, I'm sure later today, Ben, is the process for doing that. And whilst there may be the requirement for screening and identification of foreign capital, those investments are still very straightforward through the Australian FIRB.
Thanks, Brad. And we'll just jump on to the next slide where we'll take a look at what are the investors focused on that we're seeing here in Australia. So this slide here talks about the bulk of the investment we're seeing from domestic and offshore investors is at the farm gate. So increasingly we're seeing investors viewing farmland as a reliable store of value. So it's around capital preservation as well as capital accumulation. So farmland in Australia continues to prove its worth as an uncorrelated, defendable asset class. And being an uncorrelated class, it's got a demonstrable track record against prior economic shocks experienced in 2001 and 2008, as you can see depicted in that table with the growth there. So this table is Rural Bank's recent Australian farmland values report for 2019. So we see around about a 13.5% jump in average dollar per hectare of Australian farmland in 2019. which marks the 6th consecutive year of growth. We've had around about 7.5% annual compound growth rate over the previous 20 years. And as you will see, right at the end, there's a divergence between the green line and the shaded line. So that's a reduction in farmland transactions year on year, which we're seeing in recent times of about 13%. So what that means is less opportunities to expand, tightening access to suitable parcels, and increased competition with land. So we're seeing a number of operators locally and offshore aggregating assets. So when you consider the above, coupled with the high commodity prices we're experiencing, low Aussie dollar, we're sub 70 cents to the US, and cheap debt, it'll continue to drive strong market signals for the industry, albeit that will be tempered by disruptions to global economies. So taking a look at the next slide, we need to contextualise the run that Australian Agri has been on. So it's important to benchmark this data relative to value globally. So this slide depicts the NCREIF data benchmarked to alternate global investment destinations, and it references the US dollar cost of land per long time average wheat yield. So it's a bit like the Big Mac index that you see around the world. And as can be seen in this chart, Australia stacks up well in relative land value when we compare apples and apples across different territories and jurisdictions. And then we overlay that with the investment fundamentals around sovereign risk and the like. So let's jump back. We'll have a look at the sources of capital to fund the $125 billion capital gap. We'll start with the rural debt scene in Australia. So looking at the rural debt as a source of capital in Australian agribusiness. So Australia has a highly sophisticated and mature agri banking sector. Around 95% of Australian farms are held by owner-operators here locally, with debt and retained earnings being the primary source of capital investment. And bank lending accounts for 95% of that total rural lending. And when I say bank, primarily, our big four, our major banks, and that's spread across around about 150,000 farmers. And we see two-thirds of our debt held by only 1/3 of the borrowers. So that's talking about the scale of the operations as well. And we've seen over the last 20 years, rural debt in Australia continues to grow around 6.4%. And in real terms, total debt sits at about 76 billion as at June last year. So that demonstrates the support of the domestic agri banks in the sector, which is super important as debt will follow equity. Equity is always a valuable source of capital when you're constructing an investment portfolio and when you're looking at optimising rates of returns and balance sheets. So do you want to make a couple of comments there, Brad?
Sure, Ben. And obviously from that chart that whilst there's a longer term growth rate, as you quoted, at a little over 6%, you can really see a change in that pattern over the last 10 years. And it's worth just unpacking that a little. And so for those that have joined from overseas might not be aware, but we've recently had a review of the entire banking sector in Australia, the Hayne review, and we've had a series of regulatory changes that are in the process of being implemented there. So that's something that really would have only impacted over the last 2 years, let's say. But what you've actually seen on that chart is a slight uptick. And what we think that is more related to is with some conditions on particularly the east coast of Australia requiring some short-term finance. There's probably been an uptick in lending for cash flow purposes there. But if you go back around that 2007 and 8 period, what you actually see is a real reduction in lending. And what we see that has been a result of has been the regulatory changes that were implemented across the board, not just for agriculture, post the global financial crisis. And we do have a lot of concentration in the banking of agricultural businesses. We've really got 5 banks which constitute the overwhelming majority, well over 90% of all lending. So what we see is a great opportunity here as well. As we've got agriculture really proving its place in a portfolio during these times of a downturn, during the global financial crisis, and more recently, a lot of agriculture businesses are performing well in a non-correlated way, but that doesn't always match the ability of the bank sector to be able to supply that capital, whether it being for growth, whether it being in times of distress. So it's an important opportunity, the debt side of this, for investors, and it's not just an equity story.
Thanks, Brad. So on that, let's jump into the next slide and we'll explore the sources of capital. We talk about this $125 billion funding requirement over the coming decade to consider offshore and domestic sources. So this slide here is primarily focused on foreign direct investment stock in our local market. So as we can see in the light green or the aquamarine bar chart, the 3 years to 2008, we've seen foreign direct investment inflows to agriculture averaging around $7 billion year in, year out in Australia. And in particular, we've seen a threefold increase over the period from 2015 to 2018. So this $7 billion reference to the bar chart next to it is a little over half of the annualized $12.5 billion funding requirement to 2030. So we talk about $250 billion in capital to 2030, half of that from debt and retained earnings, and leaves us $125 billion. And if we annualize that over 10 years, it gives us that 12.5. So foreign direct investment will make up a little bit over half of what's required as we seek to drive the industry to $100 billion. The number of approvals in foreign investment in Australia, agriculture for 2019 dropped slightly from 223 to 201 last year. And the absence of Chinese buyers from the market was the notable change. And we'll discuss this a little later in the presentation. So what does the current, climate look like for foreign direct investment in Australia? So with COVID-19, we've seen some temporary changes to the Foreign Investment Review Board, or FIRB, rules here in Australia. So FIRB recently mandated in March that all foreign investment requires FIRB approval regardless of value. So it's effectively reduced the monetary thresholds to $0. And prior to this, the FIRB regulatory approval was required for farmland greater than $15 million. So any acquisition with farmland above 15 million required FIRB, but that was a cumulative test as well. So if you're an investor that was a foreign person, then you required FIRB approval regardless of that 15 million threshold if you already had held a cumulative value greater than that. And we're likely to see the temporary changes with the COVID-19 changes to expire on the 1st of January 2021, and that will revert the previous thresholds for agribusiness and farmland back to that $15 million threshold in that respect. Did you want to touch on any commentary around what we've been seeing with the foreign land register, Brad?
Yeah, sure. So again, just looking at the Productivity Commission report this week, it confirms these numbers, but demonstrates that there is some trends unfolding. So I think one of the interesting things you see when these are reported quite often that the UK is listed as the highest landowner, and when you take into consideration there's quite a lot of ownership in the pastoral industry from UK interests, so particularly AACO, CPC, also NAPCO have a UK shareholder. You can approximate that at about $1 billion, which is quite a part of that FDI quantum. So when you adjust for that, what you can see.
Ben, I think we've lost Brad. Yeah.
Yeah. You're on mute. Oh,
Are you
are you back? Otherwise, I'll jump in.
Yeah. Invest in ag. Don't invest in Australian internet companies. So the point I was trying to make was that what you've got is some very concentrated investments in pastoral holdings from UK interests, and then you've got a very material investment amount. What was reported this week at about 2.3% of all investment is coming from Chinese interests. Interestingly, of all of those investments, of all of the foreign investments in water, around 10% are from foreign owners and slightly less than 10% in the Murray-Darling Basin. But of that, only 2/3 actually goes into agriculture. So around 1/3 of that is going into mining. And I think one of the other points to really make here has been the growth of capital coming from countries with really strong pension or superannuation systems like Canada, like the Northern European countries. And one of the observations that we make at Gunn Agri is that in terms of the fit for investing in Australian agriculture, those North American countries and European, particularly Northern European and the UK, still are a really good fit as partners for Australian investments.
Thanks, Brad. That leads on to the next slide, where we'll just take more of a macro view in terms of the FDI stock coming into Australian agriculture. So this is really a grab bag, which demonstrates the depth of global interest in our market and asset class, and highlights Brad's point around where we're seeing that capital flow from, in particular from developed economies. Of note in this slide is the trend with foreign direct investment with China and Canada over the period. So that's depicted in the top right corner. So you'll see the two charts. Top right is China and Canada, and you'll see China starting to tail off, and the Canadians pushing on strongly. So we'll take a bit more of a look around this trend in more detail. So let's jump on to the next slide, where this shows a bit more of a pictorial. The majority of the foreign direct investments from institutional investors in developed nations, as we discussed, Canada, China, US and the UK. But what we're witnessing here in Australia is a changing of the guard in foreign direct investment in Australian agriculture. So as can be seen on this slide, Canadian investors invested over $2.6 billion in the 2017-18 period, which was a near 10x increase since 2015-16. And China was a distant second at $1.6 billion. Rewind that back to 2015-16, and Canadian foreign investment was about 25% of China's that sat at $1 billion. So let's take a look at this trend in further detail. So on the next slide, we talk about China and outward direct investment, shifting down a gear. So this slide here depicts China's outward direct investment into Australia across all investments, not just food and agribusiness. So this is recent modelling from KPMG and Sydney University, and it suggests that outbound direct investment in Australia from China fell to a decade low in 2019, and it's dropped around about 60%. Food and agri was the biggest sector for Chinese investment in 2019, with about 45% of the $2.4 billion, and that's US $2.4 billion spend, and that was largely due to the acquisition of Bellamy's Organic, which is an organic dairy operation in Tasmania, and that was a sale of around about $1 billion. So it sort of skews some of that data with an outlier transaction. So we've seen a shift in that, and why is that? We've got a number of Chinese companies now established in Australia, in particular in food and agriculture. So it's unlikely that we'll see that large-scale investment by new Chinese entrants in the short to medium term, as a lot of that acquisition investment is now moving to a production phase. And the modelling there from KPMG supports that deal activity. So we've seen bilateral trade with China up 21% to around about 240 billion over the last financial year, with our exports to China growing around about 24% to reach their highest level they have been at 153 billion. So it does show the changing of the guard with the North Americans and Chinese investment, but then you need to look at that to contextualise where that investment capital is flowing from. So the next slide we'll take a look at is really just to understand domestic market and the activity of the investors locally. So this table will talk a little on the domestic market. We've covered foreign direct investment and the sort of average $7 billion we've seen flow in year on year in the last 3 years. So locally, it's really super funds, high net worths, family offices and strategics, the main investors, and primarily family farm operators by value and volume are the number one investor here locally. Our Australian superannuation funds, they hold just a tick over 3 trillion in capital. Industry super funds control about 680 billion of that, and they've been the main contributor to agricultural investment here in Australia. There's around about 2.3 billion committed from those industry funds to the sector, and around about 70% of that's been committed since 2017. Modelling suggests that those industry funds will hold around about 2 trillion in assets by 2030. So then you can get an idea of the trajectory in terms of the invested capital into that space. Drilling down into our high net worth individuals, we've got 13 of our top 200 rich listers here in Australia, and they hold a combined agricultural wealth of around 8 billion. So they're very active in the sector, and Australia's wealthiest individual, Gina Reinhart, owns and controls around about 2.2 million hectares in the domestic market. The top 19 landholders locally control around $16 billion of agricultural assets. So it shows that the depth locally, and as I mentioned, the consolidating family farm is the most active component of our domestic market. Interestingly, in 2019, we saw around about 2.2 million hectares of Australian farmland swap hands from foreign investors to domestic ownership. An example of that was a local farming operation purchasing 2 cattle stations in the NT for around about $50 million from a high net worth Chinese investor. So it shows that recycling of capital and the domestic participants, particularly the owner-operator models, being very active. And the point there is, best in breed, best in class management platforms, management vehicles, able to club up and collaborate with domestic and with offshore investment. So on the point with super funds, I'll just ask Brad a question. So Gunn Agri, very active in raising capital in North America and Australian markets. What do you see the reasons around Australian super funds being unrepresented compared to the holdings of other foreign counterparts? And do you see that shifting anytime soon?
Yeah, Ben, it's an interesting question. And if you have a look at what allocation ag usually receives in an agriculture for a very large institution, once they do make the decision to invest in ag, you can use as a rough rule of thumb, let's say 1 or 2% of that total. So let's use that 1% number. So the industry today, the Australian superannuation industry today at about 680 billion, then that'd be 6.8 billion. And what we're seeing is investment much less than that. And the investment that's coming in is really quite interesting because it typically is not your traditional kind of North American investor or European investor that's looking at land rich and maybe some water rich type of investments. But what we've seen from the Australian superannuation industry, so the industry super funds, is typically more supply chain or value added type of investments. So investments in things like high value beef, Wagyu beef supply chains, water and high value crop irrigation, permanent crops, obviously. You've also seen some investment in beef genetics from regional super funds. So it seems as though the broad movement for farmland investment, like you saw in the US, where you've got typical own and lease type investment models that have been undertaken, have really missed out here in Australia. And that's not necessarily a bad thing. And I think to the second part of your question, do you see this changing soon? I think Australian superannuation funds are under increasing pressure from their members around the sustainability of the investments that they're making. And I think one of the things that stacks up really well for Australian agriculture are its credentials around that sustainability and its accountability. And so those super funds are going to identify that and see the value in that. And as they look to diversify away from other asset classes, which are quite pronounced asset inflation sort of trends at the moment, real estate, infrastructure, other real assets or illiquids, you're seeing agriculture certainly become, on a relative basis, more attractive than it has been historically. So to combine the sustainability elements with the attractive valuations, I think what you are going to see is a lot of these very large Australian superannuation organisations start to deploy more. And as you say, as they grow towards, over $1 trillion and towards $2 trillion, that could potentially be a very material source of that capital gap that you've identified, Ben.
No, thanks for that, Brad. So the table that we've got here obviously depicts recent market transactions. We haven't spoken about any. We're holding out. What we've done here is really just depict between some foreign and domestic transactions locally over the last 12 months, just to show that depth in the market. So the stake up there in the Northern Territory was the deal that I mentioned before with the local family buying a high net worth Chinese investor. But two deals that I'll just highlight in the interest of time, because we can talk about deals all day, which is the good stuff. It is Best and Global Food Company recently sold 4 South Australian dairy farms to Canadian-backed Aurora Dairies, so PSP-backed Aurora Dairies. The sale was a $40 million transaction, but what's interesting about that is that it was sold on sale and leaseback terms, so it allowed Beston to take that capital and look to optimise and right-size their balance sheet. So they're able to then reduce their bank debt, so they took their gearing. They'll take it from 50% down to around about 15%. Under the terms of the deal, they're able to secure a 10-year offtake for the milk supply from the farms. And then they'll take that capital. So rather than have a balance sheet heavy model, they'll look at a more asset light operating model, and they'll repatriate that capital, come further along the supply chain, so come downstream and focus more on their strategic expansion of their mozzarella business and their dairy nutraceutical business, in particular their production lines with lactoferrin, which is a higher value protein input into infant formula. So that shows offshore capital coming into an ASX listed business and then being able to restructure the operation to allow it to fund its expansion. One other deal I just mentioned is in Western Australia, and that was last year. SALIC, which is the Saudi Arabian Livestock Investment Corporation, they invested around about 200,000 hectares in Western Australia's wheat belt for about $60 million, and that was held by a local vendor called John Nicoletti. So we've got capital coming out of the Middle East, buying into agriculture into farm gate, securing a number of livestock, in this sense, a sheep operation. And then Mr. Nicoletti was able then to take that capital. He's since bought another 18,000 hectares in Western Australia, leasing them back to local farmers. And then he's also buying land in Western Victoria on the East Coast. So it shows that domestic operators on exit are doubling down in the industry. They see real value and scope longer term in asset values. given the fundamentals of the business and also proximity, but connectivity to our trade partners in particular into Southeast Asia. So that's just a bit of an around the grounds in terms of the domestic capital, who's participating, what are some deals. Happy to go into those in a lot more detail, but just in the interest of time, we'll just step on. So the final two slides we'd just like to talk about today is really to understand, before we conclude into Q&A, is that there is demonstrated capacity in the market for investment in productivity growth, even though we have seen a lot of capital come in from offshore sources and domestic sources. And a lot of that growth that we will see is in transformational farming. So what we're talking about on this slide is Australian tree nuts, just as a super brief case study. And that's just demonstrating the capacity to underpin the growth target of 100 billion. So rising health consciousness has boosted global nut consumption. We've seen around 4% CAGR in terms of annual growth rate. And these two tables here depict, the one on the left is around free trade agreements, supporting strong demand for Australian tree nuts from the likes of Japan, South Korea and China. So we've seen growth in exports in these countries of about 160% since 2014, so underpinned by free trade agreements. And almond exports to China and Hong Kong has grown from about 2% of total exports in 2017 to about 20% in 2018-19. So it really shows that with those free trade agreements with Australia, which essentially free trade rules, we're able to then move product into high value markets that are high value products. So the next slide just talks about the almond and macadamia areas planted in Australia. And the reason why we just wanted to close on this is we understand the global consumption dynamics. For almonds, we've seen a lot of capital invested into Australia, particularly from offshore. We've seen the almond industry in the San Joaquin Valley in California, similar fundamentals here in Australia in terms of water, soil, etc. So since 2001, the total area planted to almonds has increased from about 5,000 hectares to around about 45,000 hectares. And now we produce here in Australia 6% of the global crop. But many of these almond orchards were established transforming existing agricultural land and water. So what we've seen there is looking at water entitlements to produce a high value crop. So if you like, highest and best use of water entitlements. Still, the industry here in Australia is maturing in almond production. 75% of almonds are still produced on properties that have 100 hectares or less. So we haven't seen the transformation mature to the point where we start to see production coming off. In that table there, it's forecasted 2025. You can start to see it slowing down, and that will come down to obviously land and water in terms of that elasticity. And with the almond plantings that are still underway, we'll see about 50,000 hectares in the ground, which will take farm gate revenue to about $1 billion. So anchoring on that as almonds as a transformational farming story in Australian agriculture, we're witnessing a similar transformational theme playing out in macadamias in Australia. So macas is the blue graph that we see there. Macadamias are the second biggest nut export in Australia after almonds, and it's expected to hit about $350 million in export value in 2025. That's up from $82 million in 2011. And this year, 2020, we'll also see the end of a 25% tariff on macadamias through a free trade agreement with China. So we expect to see more of an uptake in terms of that exports in that sense. So Bundaberg, the Bundaberg region in Queensland is the largest sort of macadamia growing area in Australia, and plantings there have doubled in size in the last 5 years. So the point being made there is that a lot of the plantings with macadamias in Australia are coastal, and they've been occurring on old sugarcane country. So whereby we're taking operations and converting that water supply to a high value crop, not too dissimilar to almonds. So a hectare of macadamias would be equivalent to around 20%, 20 hectares of sugarcane value. So this expansion, it'll not be without its challenges with land and water. But of note, macadamias, as I said, are grown coastally. So they're primarily sitting outside Murray-Darling Basin in terms of water rights. So I'll just conclude on that. It's just a really short case study to show that there is still avenues in Australia for transformational farming strategies, and we're seeing that play out. We've seen it with almonds, and we're experiencing it with macadamias. So on that note, that will conclude our formal presentation. So I'll hand over to Kate to facilitate a Q&A session in that respect.
Marvelous. Thank you so much, Ben and Brad. I appreciate it. And we have quite a few questions coming in. Please keep adding them to the chat as you like, and I will get to as many as we can. We've got about 18 to 20 minutes we can play with, so let's get into it. Is the recording going to be shared after? Yes, it will. I can answer that one. How about, in one of the earlier slides, you were talking about Australian farmland as it relates in value to other production regions throughout the world. Are there any factors that you foresee that could maybe change that positioning, in this tight time frame of the next 10 years that we're talking about that requires all of this additional investment? Is there anything that might change the valuation on the land as it stands?
Do you want to comment?
To have a go at that one, Kate? Yeah, sure. So I think one of the factors that's going to affect assets more broadly, but particularly agriculture, because it has been lagging, has been the rising tide lifting all boats, and that of the cost of money. So what's probably different in Australia to what you've had in North America and Europe has been an interest rate which is a bank rate at around 2.75 for a very long time, which meant a well-run farm business might have been borrowing from a bank at somewhere around, let's say, 5%. And then what you've had in the last, few months really has been a reduction in that quite substantially. So now those farming businesses are banking at around 3%. What that's done is it's meant a lot of the industry players that were sitting on equity are now doing the sums around acquisition and growth. And those calculations are looking a lot better for them today than they have been. And so what we see is there being now an added tailwind to valuations. And of course, it always needs to be overlaid with what's happening in the fundamentals of the industry. And if you have a look, livestock prices in Australia, so cattle prices that are all-time high, which is really driven more around what's been happening in the local market. So there's a lot of pasture available for production at the moment, and there's been a historic recent sell down in livestock. You've got wool still at really high prices, sheep meat at all-time high prices, and the grain markets are going along they're okay. They're certainly come off from recent highs, but so you've got strong fundamentals in your yield prospects from broadacre agriculture. You've obviously got some flow-on effects from shortages of water on the East Coast. So you've got a fairly small irrigated crop in Australia on the East Coast at the moment. So what we see is there being a probably more of a tailwind due to strong fundamentals, but then a lower cost of debt. And what will be interesting and very germane to this conversation is how active equity investors will be in moving into the sector to try and position themselves around what are really strong fundamentals over that 10-year period that you discuss.
Great. Let's talk about the supers just a little bit. I have a couple of questions on those that I'm going to try to combine a bit. One is sort of just how do you increase that percentage of the local portfolios into ag, and another one is specific to COVID. What do you see as the positive and negatives with regards to where the super funds look to invest, and how might their strategies or views change in the current climate?
Happy to take that one, Ben, and you can take the next one.
Yes.
So the COVID point is interesting because a lot of institutions have had to, tend to their housework in the very near term. So what have been the immediate impacts of COVID? What's it done to their various portfolio allocations, their private equity holdings that are particularly impacted? So what we've seen has been quite different and generally unpredictable focus on elsewhere other than just core business. So what's happening on the home front, tending to their own existing portfolio, and then also moving into a more opportunistic investment phase, which is, so certain parts of the market have really been affected, and usually, outside of agriculture, the liquid part of the market of their portfolios, and you've seen a real focus on the opportunistic investing there. So, and a really interesting comment we're getting back all the time is, you would have loved to have had more agriculture in our portfolio going through COVID, but we didn't, and we'll be certainly looking at it afterwards. And that was a very similar story to the fallout of the global financial crisis. And then to your first point around how do you actually try and drive greater investment into agriculture, I think it's a combination of recognizing where the demand is, and the demand from a lot of the industry super seems to be not just for that type of core agriculture, own and lease out. Those returns don't seem to be interesting enough to earn a place in a real asset portfolio of a lot of these super funds. But it might be higher returning, more private equity style like strategies, more active strategies, and more non-core strategies, exactly like Ben mentions. Sugarcane converted to macadamias is something that's really interesting, institutionally investable, doesn't have the Murray-Darling Basin water risk, but there's enough data around it now that a big institution can get comfortable with how that investment should perform.
Great, thank you. Ben, here's one for you from Justin. He says, a big part of the attractiveness to invest in Australian land has been strong capital gains. What are the risks that you can see that may slow the capital gain or even a depreciation in ag land? And a follow-on to that is, when's the last time you remember seeing a drop in farmland valuation?
Well, the data that we presented, that there hasn't been a drop for the near term. I'd say probably and there's a recent report from Rabobank called Port in a Storm, and in that report they highlight around COVID-19 and how the farmland as an asset class being uncorrelated, and how that will start to play more of a role in asset allocation. But the big thing that came out of there, the increase in farmland values, they said, was heavily correlated to the earnings of a farm. So in Australia, a lot of farming valuations and the farming sector, as I mentioned, that family farming, is really done on comparable sales or like for like, looking at the direct method from a valuation perspective, as opposed to an earnings model as you would look at in a more of a corporatized model. So if there's a hit to earnings and income when we see our export markets, as we say, in a state of flux with COVID-19, we've got some geopolitical concerns. There's probably a push to deglobalisation. There's been a shift to protectionist and populist movements globally. So does that then flow back down the supply chain to the farm gate and start to hit commodity prices? That remains to be seen. If yes, then you may start to see asset values. The forecast modelling is that they won't be as bullish as what they have been over the last recent years. We've seen 13.2% growth in 2019 across Australia. We've seen 25% plus growth in northern New South Wales and farmland. So will we see that? That remains to be seen. But I would say that the impact on pricing would be, the main factor in that model, particularly folks that are in a more of a higher value branded product model, as opposed to a commoditized, high volume, lower margin, but a very low, operating model in terms of their expenditure.
So I'm assuming this person asking if there are any distressed assets available given the recent 3-year drought is going to be
No.
disappointed.
No, well, that's the great thing about farmland values in Australia is equity values have held. We've experienced, there's a lot of people out there feeling pain, but equity values have held. Banks have been super supportive, and the fundamentals for ag are very strong when we look at sovereign risk, low dollar. It's all there. It's just a matter of getting that earnings growth.
Yeah. Thank you, Brad. You mentioned the importance of sustainability. We have a question from Jesse. Have you seen growing appetite for investment in sustainable ag, and are investors willing to pay a premium or accept reduced returns for investments that build on natural capital?
Yeah, thanks, Kate, and thanks for your question, Jesse. So I think you can sum this up as not necessarily investors. So the short answer is absolutely yes, categorically, and that demand for more sustainable investments is really, from superannuation funds, pension plans overseas, coming from boards and members, and it's a real seismic movement which is not turning around anytime soon. And what we see as being the consequence of that is not so much this conversation about are they willing to pay a premium or not. It's going to become a license to operate question. And if you don't have the adequate ability credentials for your operation, and that might even be in a more passive model where you're buying assets, requiring lessees to operate sustainably, or if you're operating to actually operate in a sustainable way, then you're not going to be able to secure capital. And the other piece to it that we're seeing is with the emergence of green bonds or sustainability linked credit, potential savings in the cost of that debt when you are able to demonstrate a meaningful differentiated action, management action around achieving certain sustainability outcomes. So we see it as becoming a core part, and the question we see for agriculture and sustainability really is going to be, how are you achieving this? How is it credible? How is it going to be strategically targeted? What actions you're going to take? How are you going to report it to your stakeholders? Very importantly, investors. Who's going to audit that? Who's going to communicate to your investors that you've actually done what you've said that you would do? And we see this being the sustainability landscape for agriculture managers into the future.
And so you just asked a few of the questions that I was going to ask back to you in terms of how do you handle reporting? How do you quantify sustainability? You said Australia is very well positioned to deliver it. So is someone leading the charge in terms of sort of creating a unified system of reporting or metrics?
Yeah, and I think you've seen this is an area where you've really seen a level of coordination between industry and government. So, at a federal level, the role of natural capital or managing landscapes in a sustainable way, and also being accountable for sustainability across your investment and your operation, has been something that the government has made as a priority for engaging with industry. You've seen that coordinated with, national farming bodies, state farming bodies, and then you've seen it at the same time coming from a different set of drivers, coming from some of the very large investors, and you're also seeing it increasingly coming from some of the major lenders, some of the major banks. So you've really got a whole lot of work that's being done in the background. We still have this landscape where people can be talking about the same thing but using different words. People can be trying to identify what they're trying to achieve from a sustainability perspective, and there's confusion there, and there are some, I guess, cardinal markers along the way which are helping all of those stakeholders come together. So things like the UN SDGs, the UN PRI, and then in Australia you've got some state-based biodiversity credit schemes. You've obviously got the federal government carbon, and specifically programs for carbon for agriculture, the Carbon Farming Initiative, which has been in place now for quite a while. So you've got many different mechanisms, and there is a step to come where those mechanisms talk to each other better and can be coordinated better, so that there's more of a systemic approach to this is what this particular operation is doing in terms of carbon, in terms of biodiversity, in terms of input reduction, in terms of ground cover, waterway health, things like that. So that's quite an exciting area at the moment, because there's a lot of work being done across the board by all those stakeholders. So we see the next 10 years as being probably more of a consolidation of the way that all of these stakeholders are viewing natural capital or sustainability, and stakeholders like investors will have an easier way of interpreting good performance from bad performance.
Great, thank you. Ben, let's talk about FDI for just a little bit. So in terms of getting to where we need to go with the amount of investment required, do you think that the Canadians are going to keep their upward trend? Is someone else going to step in, like more Middle Eastern investment? What do you foresee as being the breakdown of foreign investment over the next 10 years?
Yeah, we need to ask our Canadian friends. But if we look at fundamentals, on Australian ag, so low sovereign risk, southern hemisphere focused, scalable assets, the ability to, particularly with horticulture permanent plantings, capital intensive to scale those up. So that's not going to happen from domestic operators. So look, there's definitely focus there. We've seen the trend moving. We sit at a tick under 70 cents in the US dollar. So we've got that there. Our commodity prices are very high. Anecdotally, we've seen investment coming out of the Middle East. We haven't seen a lot as a jurisdiction. We had Hassad, from Qatar. We had quite a large aggregation here. Recently divested. So look, I would envisage that North America, in terms of capital cycles, will still remain strong. We highlighted in the report the slowdown from FDI in China. So look, it remains to be seen in terms of what will come out of that. But there's definitely still opportunity. We're an open market for that, facilitating the capital. The Productivity Commission report just released on Monday here in Australia outlined that as well, that we do need that capital invested, because it's for productivity, which is growth, which is sustaining societal fabrics in regional communities.
Speaking to that, Alison is wondering if the Australian government is sending the right signals to investors locally and outside to attract the necessary capital to reach that 100 billion target.
Well, that's why they've looked at a coordinated approach. So the National Farmers Federation with the federal government, they've enlisted the help of our regional development corporations, so industry bodies locally, which is like Agri Futures and the like. So the Sugar Corporation, there's a range of them across fisheries, forestries, etc. And then that's sort of looking at more of an outward focus. We've got Austrade, we've got our local state governments, and then I guess we've got cheerleaders such as ourselves in that regard there. So look, it's not all about foreign direct investment. It's about how you can marry up the right capital partner with an operator. I heavily believe in our national interest and what we need to protect here in Australia, but we also, we're hungry for capital, and we need that to continue to grow our sector. And a lot of that will go into enabling infrastructure, ag tech, a lot of other biosecurity, a lot of areas that need to be built for the benefit of the industry.
I'm glad you mentioned ag tech. I was going to ask sort of a forward-looking question as we come up on our time. One of our attendees is asking, given the long-term view required for investing in farmland, how do you see disruptive tech in productivity and food production influencing land use and consequently the flow of capital into land across the decade?
For me, so what we've seen with COVID-19, there'll definitely be a larger focus on provenance of product, traceability of product, and tracing that right back to the farm gate. So how we can have enabling technology can do that, whether it's farm gate from a protein perspective, being red meat, being grains, being wine, or what that is further downstream. So once we can look at that, then it's all about the consumer. Is the consumer going to pay more for that product? And what we're seeing globally, it's probably more of a propensity to say yes, they will, given what we've seen with supply chain disruption and the like around the pandemic that we're experiencing. Okay,
great. In terms of this is kind of an interesting question from Gerhard. So it's a question about where these investments are made. Is it all just land acquisition, or are investments into current assets just as important to reach the goal?
Yeah, good question. Yeah, and I think one of the comments that both Ben and I referenced during our webinar is the flow of capital into more private equity style investments. So we can put ag tech in that as well. And there's a very large sort of share of the ag investment community that view the opportunity as ag tech or differently supply chain investments that really are more private equity investments than farmland, and not necessarily just that land rich either own and lease out type of gold with a coupon style of investor. And that really comes down to where that investment is sitting in the investor's portfolio. And if you want an investment that is a alternative from a real asset, a real estate, or an infrastructure type exposure, then ag own to lease or own to operate is still a really, really good fit. And hopefully the point that we've made here today is that there's still plenty of opportunities in Australia to get that exposure at reasonable type of valuations, and still with the same very, very safe levels of sovereign risk and with good economic fundamentals that exist. But the ag tech opportunity set is really, we're all on this call realize what a focus it is for the opportunity it can play in achieving those essentially food and fiber production objectives over the next coming decades. And really, really, really exciting, but different risk profiles. High risk, higher potential wins. Quite different though to if you want a reasonably low risk, non-correlated investment, then farmland with the operations is with an inflation link from your outputs. Is still a really interesting investment to have in your portfolio.
Absolutely. Okay, we've come up on our time. I want to take a minute to thank both Ben and Brad for the great presentation and the wonderful discussion. I encourage everyone on the call to head over to oxleycp.com and gunnagri.com to learn more about what they both do and how you can get involved. Also go to globalaginvesting.com/webinars to see what we've got coming up. And you might like to know, if you're not traveling, as many people are not, for our August conference, Global Ag Investing 2020, there is an opportunity to participate right there from your sofa. So check out gai-nyc.com to learn more about that. But I just want to say thanks again, and this will be available on recording. I will email all of you a note about it when it's available. But thanks so much again. Ben, do you want to have a closing statement?
Closing statement. No, thank you, Kate. Thank you for the opportunity. And and appreciate everyone's time and participation today. We're very respectful of that. Our time currently is very, very important. It always has been, but it's great to, the community that Global Ag Invest has built and the agricultural investment community, more generally speaking, it's a great sector to be in, and there's some great folks involved. So I know there's a range of questions that have not been answered, and I'm respectful of that. So whether that's facilitated through Kate or, more than happy for you to reach out, direct message, email. Brad and I will do our best to answer those questions and continue those conversations. So thank you for everyone's time, and thank you, Kate, and for the community, and stay safe.
Thank you very much. Stay safe, everyone. Really appreciate it.
No problems. Thanks, Kate.
Bye,
Thanks all. Thanks, Brad.
Thanks, Brad.
Yeah.